Hey everyone, welcome back. Hope you're having an amazing day. Hopefully the market is up. I know my account's up. The Qs are down. My account is screaming upwards, and it's because of trades like this. Now today I'm going to cover a trade that I didn't know anything about a couple of months ago. There's very little information on it on the internet. It's called Dynamic Hedging, and I've started to do this in my account, and I've actually created a spreadsheet specifically for tracking this particular type of trading because it's not for the faint of heart. Strap in and let's go. Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. This is not advice in any way, shape, or form. This is my personal opinion. This is what I'm doing in my account right now. Now today, I'm going to show you a trade. I'm going to set it up live in my brokerage, and I'm also going to record it in my Dynamic Record Keeper. Now, if you're a patron, you get to download the Dynamic Record Keeper in July, which is awesome. If you aren't a patron, you should probably decide to sign up and join the Discord chat. It's amazing. I'm trading every single day. Live chats Thursdays for members only, and the digital download every single month. Also, you get a copy of my rolling options record keeper. So it's win-win-win. Your first month is virtually free because of all the awesome downloads that you get. Today, I'm going to show you the trade entry of a dynamic hedge. Now, this is a very interesting strategy. I came across it a couple of months ago thanks to one of my patrons. There's very, very little information on it on the internet, but it's kind of like the golden goose. We're all looking for these trades where we have a very low capital outlay and that has massive potential to either side, because I think right now this market could move up or down. It functions kind of like a long straddle. Now, for those of you who don't know how long straddles work, long straddles are pretty simple. You buy an at-the-money put, and you buy an at-the-money call. Now, the problem with them is we have theta decay working on both sides of this trade. It's a low capital outlay, massive potential on either side, but the stock actually has to move a relatively far distance in order for me to make money before expiration. And if it doesn't, I'm just out the money that I've spent. So typically as a trader, I actually trade short straddles more frequently. I sell at the money puts and I sell at the money calls, hoping that the stock's not going to move. But there's times where I'm expecting the stock to potentially move in one direction or the other. But what I think, my assumption is that the stock is going to move around a bunch within the range and could explode to either side. And I want to set myself up with a trade that could make money like that and also make money from the movement in between. And this strategy is absolutely perfect for it. And I found a perfect setup. So let me show you what it is. So let's jump into interactive brokers, and you can see what I'm looking at here. I'm looking at ATI. The stock is currently trading at 23.85. Earnings are coming up in 2 weeks, but it's got this IVR of only 25 and the IVP of 90. Now it's kind of in between. But if I look at the stock chart on this, this is what I'm interested in. The fact that the stock has moved 3.2% today. And if we look at the size of that candle, 3.2%, relative to some of the other candles this stock moves, this is actually pretty small. This stock typically is moving around, 3 to 6% per day every trading day. And so for a dynamic hedge, this is optimal. So that's step one, is to look for a stock that's moving around a ton and doesn't have a huge, massively high IVR, because I'm going to be buying a long call and that's going to cost me money and I'm going to have to pay the extrinsic value for it. The setup is pretty simple. What I want to do is I want to buy a call that is greater than 100 days out. So I'm going to look at the January 20th, which is 179 days to expiration. We're looking at ATI. Stock is trading at 23.84. What I want to do is I want to buy an at-the-money call. That is going to give me potential upside, unlimited profit potential to the upside. So let me click on the 25 call. That's immediately going to populate this down in the strategy builder, and it's going to say buy one January 20th, 25 call. The delta is 53. Now this is where the strategy becomes important. It would be super easy for me to do a long straddle, which is just buying the put at the same price, and it would cost me, around 680 bucks, $690 debit. So if I look at the profit profile of this, you can see what happens. I've got the potential of making a ton of money in either direction. If the stock was to go up to $40, I would make money. If the stock was going down to $6, I would make some money. The problem here with this trade is, what if the stock stays in range? What if it stays between 19 and 31? all the way to expiration. Now, to be clear, I probably wouldn't hold this trade to expiration because this curve starts to become more like this peak the later it gets. So what I would want to do is hold the trade for any time that I think the stock's going to move, and then I would get out at a certain time. Now, the strategy, the delta neutral hedging, works exactly the same way. Instead of buying a long put, I'm actually going to sell shares. Now, this is interesting because I'm going to have to sell short shares in my account. Let's take a look at Seeking Alpha for a moment. If you guys aren't familiar with Seeking Alpha, I use it a ton in my trading. One of the things that I like about this right now is that it's a strong buy. The quant rating on here is showing that there's a potential that it could move up massively to the upside. Now, if you're interested in Seeking Alpha, you can use my affiliate link down below and it gives you a 50% discount, which is awesome. They give me a little kickback and I appreciate you using my links and you get an awesome discount, which is pretty cool. And I love Seeking Alpha. It's a fantastic service. So in this case, I think that the stock could go up or it could go back down pretty easily. Like, look, it could go back to $14 like it was trading last year. So there's potential either way on this because there's a strong buy and there's this previous price action where we saw the stock trading at a much lower rate, which is pretty great. I'm just also going to look at TradingView and I'm going to look at and see kind of how much movement we have. And what I'm looking for is these long, big candles. And ATI has a perfect setup. We've got earnings coming up and I'm going to be trading my long haul way out of this later date. So I'm hoping that coming up with earnings or on earnings, there's going to be a big move. This would help this trade if it moved either direction. There's another thing I need to look at, and that's the lending rate because I'm going to be selling short shares. So I'm going to go over to ATI. I'm going to right click. I'm going to go down to analytical tools and I'm going to look at the SLB rates. When I click on that, it's going to come up and it's going to show that there are at least 3.5 million shares available to sell short and the fee rate is 0.25%. So I'm going to be paying very, very little interest on holding the short shares in my account. This is important because I will always have short shares in my account. Another thing to take into account with this is that there's no dividend. You know, dividends can get tricky, especially when we're dealing with short positions, and we would have to pay that dividend out of our pocket if we're holding short shares. ATI does not currently pay a dividend. So these are kind of some of the checklists for this trade. Doesn't pay a dividend, very low cost to borrow, and lots of daily candle movement. What we're going to do is if I buy one call, I'm going to get a positive delta in my account of 0.52. But what I want to have is a neutral delta trade, and this stays neutral delta all the time. So in order to do that, what I would do is I would just sell some shares. Now I can click on the advanced button down below and I can add a stock leg to this in Interactive Brokers. Now I don't want to buy shares, I actually want to sell them, so I'm short. So I'm going to sell these shares. Now, to make this delta neutral, there's 52 shares or 52 delta to the upside. I'm going to sell 53 shares. Let me just hit enter. And you can see that it makes the trade delta neutral and it shows us the profit profile that is very, very similar to the long straddle. We've got this potential of making money. Now, the downside of this is if it doesn't move enough, if it stays within this current range. And as I said before, that's typically how I would trade with a short straddle is I want it to stay in range. In this case, I want it to move out of the range. But the beauty of this trade is that there's a whole bunch of micro transactions because I'm trying to keep it delta neutral. If the stock moves up in price, then the delta of the call is going to increase. Therefore, I'm going to be swayed one way or the other. I'm going to have further positive delta. And what I'm going to do is I'm going to sell shares if the price of the stock rises. Now, likewise, if the price of the stock goes down, then the delta is going to decrease and I will have too many short shares to be delta neutral. So I will have to buy shares. What this does is it creates many, many transactions where I'm buying and selling stock. And I'm buying when the price is low and I'm selling when the price is high. And I'm doing this quite consistently. So what I did was I actually built a little spreadsheet to be able to track this. And it works pretty well. I'll show you an example of one that's kind of filled out. This was on Airbnb. It has a January 20th expiration date. The strike price is 95. The stock, when I opened it on July 5th, was trading at 95.33. This trade is working out quite well because the stock, look what it's been doing. It went down to 92 and I bought some that went up to 96. I sold, it went down to 91. I bought. went up to 94, I sold, so on and so forth, all the way up to 107, 103, and currently trading at 104.84. So it's been moving around a bunch, and I'm currently short 68 shares. Now, at this point in time, this actually hasn't been a winning trade. I haven't actually closed, but I have the potential all the time of making money off of it. And it's costing me very, very little per day because of these transactions, buying and selling stock. It's pretty awesome, and I love it way more than a long straddle. So let me show you exactly how to set up the sheet right from the start. Now, there's an instruction sheet with detailed instructions on how to do each of the cells, but I'm just going to go over to the blank dynamic hedge. I'm going to make a copy of this. So I'm going to say duplicate. And once I've done that, pretty simple. Today, we're going to do the ATI, and I'm going to put in the option expiration date of January 20th, 23. And then I'm going to fill in the strike price, and my strike price is going to be 25. Now, the current price is actually going to be updated all the time, ENF. So what I'm going to do right now is, at first, I'm just going to open the call, and I'm going to do the first 2 transactions. So let me go over to the brokerage and see if I can get filled. Now, in this case, what I actually want to do is more contracts. So I'm going to do three contracts at the 25 that I'm going to buy, and my delta on those is going to be 52.9. So 50. So I'm going to just multiply that 0.529 times 3. And I'm going to get a positive a delta from buying the long calls of 158.7. So that means I am going to have to sell 159 shares. That will make me delta neutral. So you can see in here, the delta neutrality is in here, and I'm going to get a net credit to open this. So let me just zip in here and see if we can fill this little guy. We just have to confirm I'm buying 3 January 20th, 25 calls, and I'm selling 159 of the ATI. And I've put a limit price in here, and it's showing that I'm going to get a credit. This is important. I'm opening for a credit. So I'm just going to say transmit. I got a total credit of $28.59 for the fill, which means I got $2,859 deposited to my account. Now I'm going to open up the risk navigator, and I'm just going to show you the position. You can see that I currently have short 159 shares, and I have long 3 of the January 20th, 25 calls. The delta of the long calls is 159, and I want to make sure that my short stock has a negative delta so that my overall position is a delta of 0. Now, this is where I can also look at how much this is costing me per day to hold. It's costing me theta decay of $3. So there's a couple of expenses of holding this type of position. I'm paying interest, I'm paying dividends, and I'm paying a little bit of extrinsic value decay, which is theta decay. So now let's enter these trades into the record keeper. I'm going to go over here. I've got ATI, and you can see that it's already renamed the file. Anything that I enter in the stock symbol B2 is going to automatically update. It's also pulling up the average share price, which is showing at 23.73 right now. So that updates automatically based on the entry in cell B2. Now, today is July 25th. So I'm just going to simply enter July 25th, and it's going to tell me, it's going to give me a warning. It says I have a partial entry, check row 4. So it's got a little bit of a failsafe in here. It's asking me the option quantity that I traded. Now I bought 3 of these. So I'm going to enter a positive number and say 3. And you can see it's a buy to open call. Now the transaction price that I paid $3.06 for each of them. So I'm going to put that price in there, $3.06, and I paid a commission. I'm going to add up all my commissions, $1.05 for all 3. And there's a reason why I'm doing multiple contracts in this, and that's to keep my commission fees down. Now the option is now open, and what I need to do is I need to enter the current price and the current delta up in E2 and F2. These are the cells that I'm going to enter and change each day to see if I need to buy or sell shares. So what I'm going to do is I'm going to type in this current price. I'm going to say it's 306 because that's what I just bought it for. And I'm going to enter the current delta. Now the delta is the overall position of the whole thing. So if I look at my risk navigator, really simple, it's showing as 160. It's already moved. This is how quickly this trade works. I'm going to enter it as 159 to show you that this is how it works. It immediately tells me sell 159 shares. Now I've already done that. So I'm going to type in today's date, September 25th, and I'm going to say sell stock. Now this has to be a negative. I don't put this in as 159 because then it will highlight it red, wants to be a negative entry. So negative 159 because I'm selling. The transaction price, 23.754. So I'm going to type that in, 23.754. And I paid a commission to buy these shares, and the total commission that I paid on these, total commission of 80 cents. Entered as positive. If you enter them as negative numbers, they will show red. Even though it was a debit, I'm not putting it as a negative, putting it as both of these columns always get entered as positive numbers. And then it will tell me that this was entered for a net credit, which makes sense because I sold the shares. Now you can also see what has happened. So I paid 919 debit to buy the long calls, but I got paid $37.76. Now my net liquidation value at this point and the current cash balance that I have in my account is $2,857. That's how much money I got after commissions. So now this is just going to track all of my trades. And now it's as simple as just entering in the components as they come up. So now if the current delta changed to 160, which it already has, if I change that, it will say sell one share. Now for me personally, I don't want to be buying and selling one share. And it's the reason why I'm trading 3 lots of this. I want to be buying and selling, at least 5 shares. I don't want to do these tiny transactions because the commissions just eat up all of the profits. So what I'm going to do is I will not adjust it right now, even though it tells me to sell one share. I'll wait until the stock has moved significantly in one way or the other, and I will either buy or sell shares to go delta neutrality. Now I could do this daily, I could do it multiple times per day, or I could do it every couple of days. It depends really on how much the stock is moving and how frequently I want to trade. But the idea is to always keep it delta neutral. And in this case, the easiest thing to do if I did want to sell one is I would just type in, and the date can be the same. It doesn't matter if I'm selling another share, but I would just go sell and I would type in -1. Now what I shouldn't do is put in +1 here. It will show an error. So I've got to put in -1 if I've chosen sell stock, and then I put in the price that I'm selling it at. The stock is now up to 23.89, and I would be selling more shares. So 23.89, and I would pay some commission for that. So you can see how this strategy works already. I'm already selling stock when they're high, and if they went down, I'm buying stock, and I just constantly am making these transactions and making money over time. Now, I don't want to do that, so I'm just going to delete these out, and I'm going to leave the transactions as they are. Now, the really cool thing about this is when you close the trade. Like if I want to close the trade off, all I have to do is say, well, I'm going to sell this for credit. Say I'm closing it today, and my current price of Airbnb is $22.11, and I'm paying a commission on that of say $1.05. Then it will tell me to buy 68 shares. And then I would just come down here and I would want to zero out the position because I no longer have the long calls in play. So I would go down to July 25th and I would say buy stock, and I would type in 68 shares. And I would say the transaction price today, trading at 104.52. So 104.52. And I pay a commission. Now the whole sheet goes green. In this case, if I closed this trade, I would have had a loss of $149. Now the awesome thing about this type of strategy is you can couple it with other strategies. I've actually been selling iron condors against this dynamic hedge. So I make money if the stock doesn't move, and then I potentially make tons of money if it does move. And it's kind of like one trade is paying for the other one. So this has actually been quite a great win for me, which has been pretty awesome. You can see if you scroll down to the bottom, there's an end of formulas. This sheet could be extended, but we have a 3-month window to kind of go, yes, it's to the moon or terrible. Either way, I make money. And if it moves around a bunch in the middle, I'm making money too. So it is fantastic. I hope you guys enjoyed today's video. Remember to give me a thumbs up. It helps the channel a ton. And let's get rich together. Thanks so much for watching, and see you very soon.